Welcome again, guys, to Pure Property Investment One-on-One. I'm here today with Scott LeCane. Scott is the principal of Aussie Home Loans in Parramatta and Rouse Hill. Also, as far as I'm aware, the industry-leading franchise around the country from a home loan perspective. Yes. Little plug there. Thank you. No money exchanged. What I wanted to talk about today, and something actually is quite topical for me personally in my own portfolio, is looking at right now with the ever-changing credit environment, principal and interest versus interest-only loans, and how they're, I guess, the dichotomy of the amount or the rates that are offered for either or, and how they can reflect on an investor, and what's important and what are some of the things that people need to consider, because the differences are vast compared to what they were even 6 months ago.
Yeah, look, it's an interesting time when we're talking about interest rates at the moment. You can pick up the paper and it says NAB's dropped rates, and then so on one hand they're dropping principal and interest owner occupied rates by 3 points, and then on the other hand they're lifting rates by 30 points on investment interest only. So it's a really interesting market with rates at the moment, and I think it's important to understand why the banks are moving their rates around and what's happening. So basically, the banks have been forced to hold only 30% of their total loan books as interest-only loans. They're all running at about 40% at the moment. So the banks are being forced to drop a percentage of their interest-only loans, converting them to principal and interest. So what we're finding is rates for interest-only loans are going up to make them less attractive, and often principal and interest rates are coming down. So the banks are trying to get people to swap over, or certainly encourage people to swap over, or think about the principal and interest options. So I guess from an investor point of view, traditionally we've always said interest only is the way to go. It's actually interesting now to do the maths for people to say, okay, well, principal and interest, I can actually get this rate. If I'm looking at interest only, I'm paying this rate. So it's still working out more expensive, obviously, to do principal and interest, but it is starting, even with investors, to make the effect of dropping that 10% down that the banks are after by, making it feasible for an investor to say, look, principal and interest is 80 points cheaper. Potentially I should look at doing that even though I'm an investor. But it's a no-brainer for principal and interest loans on owner-occupied properties. Certainly that's a bad debt that you want to reduce down, and you're getting the best possible rates, owner-occupied, principal and interest. So certainly that's the way to go. And it's an interesting discussion with investors now to say, here's the principal and interest repayment versus the interest-only repayment.
Yeah, it's most certainly an interesting time, and I think if you can, again, going back down to your cash flow modelling, if you can sustain a small hit, remembering if you're going negative into your entire portfolio over a year, then anything negative is obviously potentially going to be tax deductible. Yes. But second to that, I mean, if you, like you said, potentially 80 points difference for a P&I versus an interest-only loan for an investor, you're talking the potential to go into a 3 or a 5 year fixed position, and by the end of that period, you're going to have knocked off a portion of your principal. So you've got to think you're going to be in a better position as well.
If you're looking at your portfolio saying, okay, I've got $1 million, if I look at a fixed principal and interest investment loan opposed to my interest-only variable loan, there could be 80 to 100 bips between the difference. So it's well worth doing the maths to say what's best for me.
Absolutely, and I think that's the key right now is I think for any investor out there who's sort of sitting in a position where they've got some loans which aren't fixed, so you can actually look at what the options are out there with them, and then from that point saying, well, let's model the different options, P&I versus interest only, looking at potentially lowering some of your LVR position over the next 5 years and figuring out how does that fit into your overarching objectives and cash flows. But always, as always, I think contact us if you do want to understand that in a little more detail, as well as Scott and his team. Always happy, I'm assuming, to take a phone call to discuss your position and how they might be able to help, or at least just give you some general advice. You can contact them, details are at the bottom of the screen, as well as ours, and we'll catch up with you soon. Cheers.